It's tax attorney John Hyre, Hyre here, answering another question. These are the sorts of questions that we answer in the inner circle. You're going to notice I like to do more than just answer the question. I like to go into great detail and explain why. I think that's a lot more useful. So I've accumulated bonus depreciation as a limited partner over the last 5 years in multiple states. The CPA said all those years, there's no need to file returns in those states. Now, I don't know if that's true or not. That depends on which state. There are 50 of them. They have very different rules. For example, with the IRS, if you fail to file a partnership return, which is what this is, right? Somebody's an LP, it's a partnership return, and you fail to file the partnership return, there's a penalty. Now, probably what's happening here is the LP has not filed individual returns in those states. And probably that's okay. Depends on each state's rule. Most states, if you don't have income, you don't have to file an individual return. Now, I will say this, if you don't file an individual return, generally the statute of limitations also never starts. Now, if you're not worried about any issues in those states because it's pure losses and you have no other presence, you're probably okay as a practical matter. But there may be some states that require you to file a personal return, even if you have losses. I would in particular pay more attention to the communist states. So if you're dealing with California, New York, Illinois, New Jersey, places like that that are very socialist, punitive, will do anything to get a hold of your money, they tend to have much worse rules that may follow you to require returns where other normal places would not. By the way, if that's offensive, I'm really not someone for you to listen to. If you vote for socialism, you shouldn't be surprised when you get socialism, which means trying to extract as much money in as many ways as possible from the citizenry, including odd or very strict and unfair rules. That is part of how it works. If you don't like that, probably you should just, never listen to me again. Now, I got final K-1s with positive income in those non-resident states. So you've got positive income. Do I need to now file the accumulated depreciation and income in each state, or can I just do it in the state return I live in? That's going to depend on the local state. Again, I would say in a lot of states, it's kind of a lot of places are going to take a no harm, no foul rule. Let's say you have some income there, but the accumulated depreciation would offset the income. You probably can get away, with not filing, even if formally you're required to file. Now, let's say you have more income, which generally you would. Usually what happens is you have bonus depreciation, then there's a sale of a property, if this is a real estate syndication, it may not be, and the gain is much larger than the depreciation. If the real estate is in a given state and there is net gain, so you sold the property, let's say you made $100,000, you had accumulated bonus depreciation from prior years of $20,000, net gain of $80,000, you do need to file in the state where the property is located. All states, every one of them. If you sell real estate, even through a partnership, because as a partner in a partnership, you are deemed to have done what the partnership did. You are deemed to have done what the partnership did. So if in California or in Ohio or in Indiana, it's sold a property and there's net gain, you report in the state where the property is first. And then in your home state, usually there's a discount against the tax. For example, Ohio says if you sold a property in Indiana, you have to report the full gain to Ohio, but you get a credit for the tax paid in Indiana. So if the tax in Indiana is lower, you pay the difference between Ohio's higher tax and Indiana's lower tax. Now, different states have different schemes. But generally, if a transaction occurred, there was gain in a state where you don't reside, but you generated gain there, especially on the sale of real estate, personal property and other assets become a little more dicey and iffy. Now the rules get a lot more gray, but the general rule is you report the sale in the state where the sale occurred, you report the gain there, and then in your home state, you report that we had gain, but we also paid tax in another state. And then your home state, depending on which one it is, they have very different formulas for how much credit do you get for any taxes you paid in that other state. But it is state by state. Now, I will say this, This is a question. So thankfully you didn't include states and I didn't have to look. This is a question that a good first shot, like I crack on AI a lot because there are a lot of idiots out there. There are a lot of tax consultants. Suddenly there's just a ton of them who are telling people all these cockamamie tax savings ideas without understanding the details. So there's that side of AI. It's making a lot of geniuses who aren't. But the other side is there are some questions AI is pretty good at. And I would frame this question, but very specifically. I would say I had this much loss in year one, this much loss in year two, et cetera. I reside in Ohio. The property was in Montana. It's sold in Montana in the 5th year for this much gain. Where do I report it first? I'd be shocked if it said anywhere but Montana. And how does Ohio treat that? This is the kind of question, you can't just trust the AI uncritically, but it's a good start. It's a good start to asking this kind of question. So my answer is, for the gain year, you should file in the state where the property was sold first, and then look to your home state and how much credit they give you for having paid taxes in that other state. So to be clear, you file a personal tax return in the state where the property was sold based on the K-1, and then you file a personal return in your home state and see what kind of credit you get for taxes paid in that other state.